89% of retail investors lose money during CPI week. Not because they're stupid, because they're unprepared. And right now, with Wednesday's inflation data about to drop, most of you watching are about to make the same mistake. Here's what I'm going to show you. The exact data releases hitting before CPI that smart money is using to front-run the move. Why SPCX is flashing a signal we haven't seen in 14 months, and the specific price levels where this market either holds or breaks down hard. Let's get into it. First, understand why this particular CPI print matters more than the last 6. The Fed has been walking a tightrope. Inflation came in sticky last month. Core services, that's the number Powell actually watches, remains elevated at 4.8% annualized. The market is pricing in a 67% chance of rate cuts by September. If this CPI comes in hot, those odds collapse, and when rate cut expectations collapse, so do overextended equities. But here's what makes this week uniquely dangerous. We have PPI data dropping Tuesday. That's the Producer Price Index, wholesale inflation. This number leads CPI by roughly 3 weeks in directional terms. If PPI surprises to the upside tomorrow, you'll see institutional repositioning before CPI even releases. They're not waiting for Wednesday. They're acting on Tuesday. Now stop for a second. If you're thinking about skipping ahead, don't, because what I'm about to show you on SPCX is something even most professional traders aren't discussing. SPCX, the S&P 500 consumer discretionary sector, is sending a warning. This sector lives and dies on consumer spending expectations. And right now, the relative strength of SPCX versus the broader S&P 500 has diverged negatively for 11 consecutive sessions. The last time we saw this pattern? March 2023, right before a 7% drawdown. Here's why this matters for CPI week. Consumer discretionary stocks price in inflation expectations before the government tells us the official number. When SPCX underperforms while headline indices hold steady, it means big money is hedging against an inflation surprise. They're selling the most rate-sensitive sector while maintaining index exposure. That's a defensive rotation hiding in plain sight. The technicals confirm this. SPCX is sitting right at its 50-day moving average, $178.40. Below that, there's an air pocket to $171. That's a potential 4% drop with no support. If CPI comes in above 3.5% year over year, I expect that level to break within hours. But wait, there's another data point dropping before CPI that could tip the hand. Monday's New York Fed Inflation Expectations Survey. This measures what everyday Americans think inflation will be, and it's been creeping higher. Last month, 3.3% one-year expectations. If Monday's reading pushes above 3.5%, the Fed has a perception problem on top of an actual inflation problem. Markets hate uncertainty, but they despise a Fed that looks behind the curve. So how do you actually position for this? Let me be specific. Scenario 1. PPI comes in soft Tuesday, inflation expectations hold steady Monday. This is the green light scenario. Consider adding exposure to rate-sensitive sectors. SPCX becomes a buy at current levels with a stop below $176. Scenario 2. PPI surprises hot, expectations rise. Reduce discretionary exposure immediately. Consider inverse ETFs or raising cash. The asymmetry favors downside protection. Scenario 3, and this is the trap most people fall into, mixed data. PPI soft but CPI hot, or expectations high but CPI comes in line. These scenarios create chop, violent two-way moves that stop out both bulls and bears. In mixed scenarios, the winning move is often no move. Size down, wait for confirmation. Here's the critical level to watch on the S&P 500, 5,250. That's the line. We hold above it through CPI, and this bull market continues. We break below with conviction, and we're looking at a retest of 5,100. That's 3% lower within 2 weeks. Let me leave you with this. The market doesn't care about your opinion. It doesn't care about your portfolio or your retirement timeline. It only cares about data. And this week, we're getting a flood of it. The investors who win aren't the ones who guess right. They're the ones who prepare for multiple outcomes and act decisively when the data confirms direction. 89% of retail investors lose money during CPI week. Don't be in that 89%. If this gave you an edge, subscribe right now and turn on notifications, because when Wednesday's numbers drop, You need to be ready, not scrambling. I'll see you in the next one.